Hello everyone. By the time this video comes out, I believe it will be the day before Nationals, and I'm sure we're all excited. But the purpose of this video and a few more resources that are going to come through today is just to put the finishing touches on a few things for you to just read or learn and watch through so that you have a better understanding of some of the content we've tried to put through this year. This particular video is going to talk to you about credit and credit systems, how they operate, um, and a wide variety of other things that have come from that. I want to set a disclaimer before I continue with the PowerPoint slide that it's thematically using the music video for Jay-Z's Story of OJ because I think I'm happy to be coaching a POC majority senior squad, and I think there are many rampant stereotypes about POCs and black people and how they utilize and work with money. So I think this video serves that very same purpose of educating us about what we can do with credit and the different ways it works in our society. So I think a good portion of that is also going to be discussing how that looks for people who look like you or people who look like me. So yeah, I hope that the presentation is helpful to you. Cool. So what we're going to go through is we're going to go through what is credit. We're going to go through different types of credits. We're going to specifically focus on bonds, mortgages, and how they're financed as well. We're going to look at the 2008 stock market crash, what caused it, and what happened afterwards. And the last thing, and arguably one of the most important things to come from this lecture, is we're going to understand the conversation around poor people and their financial practices. Cool. All right. First things first, then, is what is credit? So, credit is a financial arrangement that allows an individual or entity to borrow money or access goods and services with the understanding that repayment will occur in the future. It represents a trust based transaction where the borrower is provided with resources upfront, often in the form of money, and agrees to repay the lender over time, typically with interest. Credit is a crucial aspect to the modern financial system, enabling individuals and businesses to make purchases and investments and important transactions even when immediate funds are not readily available. The responsible use of credit can contribute to building a positive financial reputation, while the mismanagement may lead to challenges. So, in basic form, credit is borrowing money with the hope that someone or the person that's borrowing will pay the money back. It's important for financing nearly everything that we do in society. Credit is such a crucial aspect of our financial systems, which is why I'm placing a lot of emphasis on it. We're going to go through the different types of credit in the next slide. All right. With respect to different types of credit, the types of credit I'm going to go through here often overlap. I think the ones I'm going to go through in the next slide as well, they also do overlap. So one type of credit could be inclusive of another type that I'm going to discuss as well. And I think when I go through these, you're going to understand. So the first type is revolving credit, which speaks to credit cards, for example. They allow you to borrow up to a certain limit, and then you have to repay the amount that you've borrowed. And then once you repay that amount, you now have available credit again. So it's a revolving system. Then there's installment credit, which could be an auto loan, which is more valuable for like purchasing a car. And as the slides say, they have a fixed interest rate. But also it includes personal loans. So these are loans that have a fixed amount and you repay them over a specified period with regular scheduled payments. Then there's open credit, which similar to a credit card, it allows you to borrow up to a predetermined limit, but the interest rates may be lower than those of a credit card. Then there's secured credit, which we're going to focus on quite a bit throughout the presentation. So this is credit when you borrow money and you use collateral as a form of security. So what that means is, in the case where you don't pay back that money, there's something else that can be taken from you, or they will remove it from your ownership. So that specifically refers to secured credit. And then unsecured credit uh, is the opposite. So there's no collateral that's a part of the process. So it's based on your previous credit history, and the interest rates are generally higher. Then there is mortgages. And when we look at the different types of mortgages as well, you'll understand what I mean when I say overlap, because I think some mortgages or some types of credit that rely on the mortgage system are very much a type of secured credit. So these are loans specifically for real estate and purchasing houses. They have a longer term of payment, so 15 to 30 years. And then there's business credit, which are loans that are specifically for, paying off expenses in businesses or just starting a business. So all types of loans that are purposed with replenishing businesses or manufacturing them. Then there are charge cards, which are similar to credit cards. They require you to pay up the balance in full each month, um, and the difference here is that they don't have a spending limit per se. Then there are payday loans, which we're also going to focus on. So the short-term, high-interest loans um, that are meant to just cover you until your next payday. So they're very high in interest, but we'll talk about them later. Then there's store credit, and this is credit that's offered at retail stores, and it allows consumers to make purchases, like opening an account with Edgar's or something of that nature. So that would be store credit. Then there are home equity loans. So these are loans that allow homeowners to borrow against equity in their homes. So the home serves as collateral, um, and the funds can be used for a variety of purpose, which again is similar to what we spoke about when we were discussing secured loans. So we can see that there's overlap. Home equity lines of credit as well, very much linked to home equity loans. So they allow homeowners to borrow using their home as collateral, but they operate more like a credit card, like a revolving credit card, where it's think about how a revolving credit card works. But if you fail to pay what is necessary for the revolving credit card, not only do you not get credit so that you can borrow again, but you also then stand a chance to lose your house essentially. Then consolidation loans is when a bunch of types of credit or a bunch of loans are clumped together to make it easier to pay off loans. Um, and usually the interest rates are, I think, lower when it's a consolidation of loans. Yeah. All right, let's talk about the focus that I said we'd have, which is on payday loans. So, payday loans are generally loans that are taken by people to just hold them over until their next paycheck. We're going to go through the process of it, but they generally have very high interest rates and quick approval process. And the reason why they have high interest rates is because they often are given to risky lenders. So the high interest rates is generally used to compensate for the fact that you may default on the loan, or many people default on the loan, and that you're a massive risk. But I think when we talk, like, it's the degree to which the degree to which interest exists for the loan is bordering, or not even, for some people exceeds the border for predatory lending, because it can go up to 300 or even 800% in some cases. That's a ridiculous interest to have on an amount of money. But yeah, that's basically what payday loans are for. A lot of people growing up in lower to middle class upbringings, payday loans are something that is a normal part of getting through each month, which then begs a bigger conversation of how financial institutions manipulate the socioeconomic status of individuals to just milk more profit out of them, specifically people who don't have the credit record to take a more secure and less risky and less interest heavy loan from a bank because they're previously disadvantaged, or because they simply don't work the kinds of jobs that allow them to accumulate credit in a meaningful way, or they haven't been given education on how to start building their credit. So, yeah, um, we're going to talk about it a bit, in the next slides. I just really think payday loans are a concerning and interesting aspect of credit. So in terms of how they work, so there's an application process, but this is generally a very quick process. So you just provide a proof of income and very minimalistic stuff, then you get approval and you get the funds, and then you're expected to repay the loan when you get paid again. So this is obviously information that you'd provide them with. In terms of where you can get payday loans, it can be from storefront lenders, it can be from online lenders, check cashing stores, or even pawn shops in some cases. So yeah, and then looking specifically at the advantages and disadvantages of payday loans, they're a quick access to funds. So I think for um, familial units or people that need them, they provide relief in the middle of the month when it's necessary, because jobs or other expenses may make it incredibly difficult to maintain the house for 31 days on whatever salary you may potentially have. So that quick access to funds may be necessary. Secondly, they like there's no credit check, so which means that as a person who may not have an excellent credit score or may not have had the opportunity to build your credit score, you have access to funding that can help you alleviate a situation, or just any access to any credit that could be potentially helpful towards you. And then with the application process is simple as well. So there are no barriers to entry, um, because I think also credit from banks and other institutions requires a very lengthy, laborious, and nuanced process, whereas with payday loans, it's a much more simple process. So it is designed specifically for it to be as accessible as humanly possible. However, there are problems with payday loans. Firstly, high interest rates bordering on predatory. We've had this conversation. Secondly, the short repayment period means that in the case where you have an emergency, or just because of how ridiculously high the interest rate is, you are unable to pay, then there are problems. It places a lot of financial strain on a group of individuals who are already taking the payday loan because they don't have access to a vast array of financial resources majority of the time. And it plunges you within a cycle of debt. So depending on what side you research of payday loans, you could get statistics and data that suggests that majority of people are able to pay back their payday loans. You could get statistics and data that suggests that majority of people are plunged into debt, into further debt when they get payday loans. This is because the group of people who it services are people who, in the absence or presence of payday loans, would have more than likely been like plunged into debt either way. So in the case where a payday loan is, and I'm saying that they would have been placed in those situations because for majority of, say for example, black middle class families, you are two paychecks away from being below the poverty line. That's a real statistic. It's not even manufactured. So that is middle class. The people who don't have the ability to accumulate a credit score would be in an even worse off position. So it is likely plausible that they may be involved in a cycle of debt with or without the payday loans. Tag on a loan that has a 800% interest rate on it, then for some people that certainly places them in the kind of horrendous cycle of debt that is otherwise inescapable sometimes, but it is. So then this also leans into the other two disadvantages that I've kind of spoken to you guys about, which is the fact that it could be seen as predatory by some people, and that it could also impact your ability to be financially stable. Yeah. I think this was also a topic at Worlds. It was a prepared motion at WSDC in 2019, and I did I believe, an opposition three. Yeah, an opposition three to this house should ban payday loans, and I still think it's a very interesting topic and conversation. It is one of primary reasons I've become a lot more interested in economics now than I was then. So please feel free to ask me questions on it, or if not asking me questions, just researching it for yourselves as well. All right, let's talk about bonds. We're not talking about the emotional bonds here. We are also not talking about spiritual bonds. We are much less likely talking about chemical bonds. None of that covalent stuff that you guys learn there by chemistry. Um, I'm pretending as if I don't learn it as well. So, bonds are debt securities representing a form of borrowing for governments and corporations. So, an entity issues out a bond. It's essentially taking a loan from investors. In return, the issuer agrees to pay periodic interest payments to bondholders and return the principal amount at the bond's maturity. So, what that ultimately means is that a bond, or the person that issues the bond, it's kind of like putting an IOU into the ether. It's like, I need X amount of money. So that's issuing the bond. And then investors, government, or the central bank will buy the bond, meaning that they will finance it upfront, and then they will get their money back through periodic coupon payments. So that's basically how a bond works. But we're going to get more into those details now. All right. So, with respect to how bonds work, so firstly, like I said, there's an issuance, which is you issuing out the bond, and then second part is coupon payments, that's you paying back the bond. Third one would be maturity. This is when, or the specific date when you would have paid back the principal amount, in some cases the interest as well. But when we look at amortization, you'll see why I specifically just said the principal amount. But the maturity refers to the date when you fully paid the bond, and then there's the principal or face value. So this is the amount that the bondholder will receive at maturity. Then there's the secondary market. So bonds can be bought and sold in a market, basically. And we'll talk a bit more about how the pricing for bonds and all of that works. But bond prices in the secondary market may fluctuate based on interest rates, economic conditions, and the issuer's credit worthiness. So these are all factors that lead to the valuation of the bond. And then the yield is the effective interest rate that you're going to earn on the bond. Then credit ratings, of course, are assessing the credit worthiness of the individual who issued the bond. Then the risk and return, based on the credit worthiness and based on the previous factors, how likely is it that you're going to get a valuable return, and what would that valuable return look like? All right, let's kind of break down a bit more of these words into greater detail. So let's look at bond yield, for example. So bond yield refers to the rate of return an investor can expect from the bond, basically. So there are three ways that bond yield is measured. So the first one would be the yield to maturity. So yield to maturity specifically refers to the total return expected by an investor if the bond is held until maturity. So if the bond is not sold or anything and it's held until maturity, what are they expected to get out of that? So it incorporates the annual interest rates, but also the potential capital gains and losses. Then there's yield to call. So this is more so relevant to this thing, callable bonds. So this calculates the yield you will get if the issuer decides to redeem or basically call back their bond before the maturity date. What this specifically means is, what if the bond is fully financed and fully paid back before the date that we had set out that it would mature based on previous calculations of interest and monthly installments, which can happen sometimes. It's more harmful towards the people that issue the bond because it obviously means that they're unable to collect more interest. But oh no, I mean, it's more harmful towards the people who buy the bond because they aren't able to collect more interest. But to people who issue a bond, it's generally cheaper, at least on the basis of long-term calculations. It is cheaper to fully pay back the bond before its predetermined maturity date. I think it's a way a lot of people maintain a good credit score while not feeding into high interest rates as well. And then there's yield to worst, which refers to the lowest potential yield if there are multiple scenarios. So that's, um, you know, change in call dates or any other scenario that could change the ability of the bond to be profitable. And then obviously current yield is this thing calculated by dividing the annual interest rate payment by the current market price of the bond. So it provides just a simple yield calculation, but doesn't like consider all of the factors that we just discussed. So current yield is like ideal scenario or scenario devoid of context. I'd much rather describe it that way. Cool. Now let's chat about bond maturity. So, bond maturity is the date on which the principal amount of the bond becomes due and is repaid to the bondholder. So, like we were discussing earlier, a bond, when you issue a bond and when the bond is purchased, there is an agreement that says that by this specific time, you have to have fully paid the bond. You have to have made all of the payments and you have to make them period in this particular period. So you have to make a payment once a month for the next 20 years on your house, for example, if you're paying off the bond on your house. So that date is the date of the maturity of the bond. However, like I said earlier, you have the opportunity of doubling, tripling, or however amount, like basically tripling the amount that you're paying on that monthly basis so that the bond is paid before its maturity date. Again, big oof for the person who purchases the bond, but for you as the issuer of the bond, it's definitely a cheaper option on you to do it that way because you pay less interest over a long period of time. And then when a bond reaches maturity, the issuer repays the face value. All of these are things we've discussed. I'm not going to spend more time on them. All right. So now I want to chat about mortgages. So, a mortgage is a financial instrument that serves as a loan agreement specifically for the purpose of purchasing real estate. It is a legal contract between a borrower, so a home buyer, and a lender. The mortgage provides the borrower with funds to buy a property and it is secured by the property itself. In other words, the property serves as collateral for the loan. Simply put, a mortgage is a loan that you take out to buy your home, and if you default on that loan, or if you don't pay the loan, or whatever the case may be, then the bank or the issuer of the mortgage can just repossess your home. So that's called foreclosure. They can foreclose and basically take ownership of your own home. Let's chat about how mortgages work. All right, let's chat a bit about how mortgages work then. So, simple part, there's the application process, then your loan gets approved, then you buy your home, then you put a down payment. So, a down payment refers to a large sum of money that you would pay towards purchasing whatever asset that you want to purchase, which is a mortgage, which is a home in this particular case. So you put a down payment, and the down payment means you have to pay less you have to pay less per month because obviously, say you put down 100,000 rands for a 1 million rand house, that means that you're now dividing 900,000 as a principal amount across multiple months, and you're no longer dividing 1 million. So obviously, the decrease in the amount that you're paying means that you have to pay less on a monthly basis, but it also means that your mortgage is deemed as more secure because you've already made a particular payment. So it's not as much of a risk because some of the money has already been received. So that's basically how the down payment works. Then you make monthly payments. There's an interest rate attached to it. The interest rate obviously is the amount that they're tagging on to the principal amount of the loan, so that, or of the mortgage, we call it that, so that they can make profit out of it. Then there's amortization, which is what I might have referred to a bit earlier. But amortization refers to the way that they're structuring those monthly payments. So basically, the greater portion of your monthly payments will go towards paying off the what is it? It'll go towards paying off the interest rate. So the interest amount that's been tagged off each time you pay per month on that mortgage, you are going to pay, the bulk of your payment is going towards interest. And whatever is left over, that's going to go towards the principal amount. So over time, the more you pay, the less like you will have to pay on interest, and the more you will pay on principal amount. So the ratio of interest to principal amount when you start paying is you pay a greater interest rate per month than you pay a principal amount. But over the months that you pay, the fraction of interest rate to principal amount will consistently shift to the point where towards the end it will be 90% plus principal amount that you're paying in your monthly payments, and you'll be paying a small portion of interest. So that's basically what you need to know about amortization. Then obviously property ownership, you own your house. Uh, and then from there, I'm going to cough for a second. All right. Then from there, it's building home equity. So the more you make payments, the more equity you build on your property. And then maturity, of course, refers to once you've made the full payment and the mortgage is fully paid off. Remember, we spoke earlier about even the maturity of a bond, and I defined it as when the principal amount is paid back. And I said this is specifically referring to amortization. So because over time the fraction is shifting to more towards you paying the principal amount, and the principal amount is really the amount that's like paid off towards the end. When you've paid off the principal amount, you would have paid off the interest earlier as well. So finishing the process of paying off the principal amount means that you are done with that mortgage and you are done with that bond, definitively speaking. So that's what I was referring to there. In a second, we're going to talk about what makes mortgages profitable. So what makes them profitable is this very lovely thing called mortgage-backed securities or mortgage-based derivatives, which I know you guys have a very beautiful history with and you love them so much. So let's talk about them. So a mortgage-backed security is a type of financial instruments that represents an ownership interest in a pool of mortgages. These securities are created when financial institutions bundle together a large number of individual mortgages and sell shares or bonds backed by the cash flows of these mortgages. Mortgage-backed securities are a form of asset-backed security that play a key role in the secondary mortgage market. So, in order for you to be able to take out a mortgage, a bond, or a loan, whatever the case may be, there has to be somebody who finances it. And in order for someone to finance it, there has to be a market where it is profitable for bonds to exist or for mortgages to exist. So mortgage-backed securities create that profitability. So what they do is they take a bunch of mortgages and they clump them together into a package. Once they clump them into a package, they it's like siphon it to, we'll call it a company for now, but when I'm explaining the process better, you'll understand it more. But to a company, then for that company that they've sent all those mortgages to, they sell shares. So every time you pay back your mortgage, or multiple people pay back their mortgages per month, those shares issue out dividends. So the people who bought those shares in that clump of mortgages will get shares per month based on will get dividends based on the payments that people in the mortgages are making. I don't know if that's confusing. I'm going to try to explain it better in the next slide. So in terms of how they work, The first step is the creation of a pool. So what this is inclusive of is all of the mortgages that were issued out are going to be clumped together. That's the pool. So they're going to be placed into one like big package. So that is the pool. Then the second step is securitization. So securitization is when the pooled mortgages are transferred to a special purpose vehicle or a trust. This is the, in inverted commas, the company I was speaking about. So that trust is going to issue out securities backed by the cash flow of these underlying mortgages. So that could be issuing out shares to people, or that could operate in the form of issuing out even more mortgages that are going to be financed by this pool of mortgages that we just established. Then the third step is tranching. So tranching, and I don't want to get into too much details when it comes to it, because I don't think it's necessary for you guys to know the specifics. But tranching refers to when there is when the loans that are put in a pool are separated into multiple categories. So there is a junior and a senior tranche, basically, and there's a third one. I think it's a mezzanine tranche. But basically, how that works is the low risk. There's one category for low risk loans, but they also give you low interest. So the low risk and low interest mortgages are one tranche basically, but they're not like they're a more secure type of investment because you know you're going to get payments, but they're also more conservative because you know that the interest rate is going to be low. Then there's the Mizan tranche, which is basically the middle. Then there is a lower tranche, which basically is like low security in the sense that it's a more high risk investment, but it's also a um, higher interest rates and higher returns, which you'll always note when it comes to investment. The higher the risk, the higher the return. And that's how they're kind of sectioned off. But you don't that's not information that I think will be that valuable for your life at this rate. Then there's interest rates and principal payment. I'm not going to go over that. We've already had a conversation about what that looks like, and we've already had a conversation about how it's financed. And then there's credit enhancement. Then there's also risk distribution, which we already, I think, covered to reasonable detail when we spoke about tranching. All right. Just like the previous page collapsed, so did the stock market in 2008. And we're going to talk about it. Because now that we understand mortgage-based derivatives, we can understand what happened. So the 2008 stock market crash was a significant and severe financial crisis that had far-reaching effects on the global economy. It was triggered by a combination of factors relating to the housing market, financial institutions, and complex financial products. Let's get into exactly how it happened. All right. So the first thing was the housing bubble and subprime mortgage crisis. So the root cause of the crisis can be traced back to the U.S. housing market. So in the years leading up to 2008, there was a housing bubble characterized by inflated home prices. Lenders encouraged government policies and financial innovations issued by substantial numbers of subprime mortgages. So let me just explain to you what that means. So a housing bubble means that, or even in because I know there was a previous video I did on the Reserve Bank that also made use of the word bubble when speaking about quantitative easing. So when we look at a bubble in economic terms, it refers to when something keeps getting inflated and it just keeps getting higher and higher and higher. We know that eventually a bubble is going to pop. It is going to consistently rise, probably, love it for it. It might even get larger, but it is going to pop eventually. So the housing bubble here was the consistent increase in housing prices because houses were selling like hotcakes and they thought, yes, of course, we can continue to raise prices and we can continue to sell houses. Here's where the problem came in, and that's point number two, which is securitization and the complex financial products. So financial institutions packaged these subprime mortgages into mortgage-backed securities and collateralized debt obligations. So CDOs essentially function the same as mortgage-backed securities, but it's not just mortgages; it's a bunch of other invest in a bunch of other assets that are clumped together in collateralized debt obligations. So the securities were often given high credit ratings, despite an underlying risky mortgage value. So what this means is that banks now still have, or there were still houses to sell, right? But there were less people who were able to buy these houses because everyone who could reasonably afford to buy a house of a certain category had already, bought it, because again, that the market is booming. Then what happens from there is that the loans that are put out then become significantly more risky. So they lend money to people to buy houses that people cannot afford to pay back. So the logic behind it goes all the way back to mortgage-backed securities. They think, hey, one loan on its own, if it's a bad loan, it's fine. But if you group 100 bad loans together, then there's strength in numbers. So when all of these horrible loans are pulled together, they're going to be relatively more secure, and you are more likely to make back the money from the people who will default on the loans or who will not be able to pay off these mortgages. So it's still a sound and great financial investment. Based on that logic, they said, yes, let's continue issuing out these risky mortgages. That's problem A. Secondly, they were like, these institutions that rate whether or not our loans are good or bad, let's maybe collude with them so that they give our loans a triple A rating, which is like the best rating. So they can give our loans a great rating. We know that we can still continue to make money. We just need our loans to look attractive to people so that when they're being grouped into mortgages, or so when people are wanting to buy shares in a mortgage-backed security, then they can think, oh, this is backed by triple A loans, and they can still buy these shares so that we can continue to make money and so that the security can continue to make money, because there's no problem here, right? There shouldn't be no problem. No, there was a problem. There was definitely a problem with their thought process. So, unfortunately, one bad loan and 100 bad loans are still 100 bad loans, which means people could not pay it back. So, there was a deterioration of MBS value. So, as homeowners began to default on their subprime mortgages, the value of mortgage-backed securities and CDOs plummeted. So, like logic would have it, if people are not paying back, you won't be able to pay dividends on your mortgage-based derivative. So, the value of the mortgage-backed security and the CDOs just fell because everyone was defaulting. So, financial institutions took massive losses on their assets. And that's what led to a crisis of confidence. What you'll notice a lot of times with economic crises is that confidence is a massive part of it. Even looking at the banking crisis we were speaking about of 1907, or even the Great Depression, everyone loses confidence in the market. People want to withdraw their money because of fractional reserve banking that we already spoke about. Not everyone can do it. And the lack of confidence is what starts to make the market deteriorate. So, because of the massive losses that banks took, and the lack of confidence also meant that people wanted their money back, it meant that banks essentially failed. They failed and they required bailouts. So the fail in the US, and we're going to speak about this in another resource in a second, the world is heavily dollarized. So we do international trade with dollars. So a fail in the US's economic system meant that the value of the dollar globally started being a problem. It meant that trade for the rest of the world started being a problem because of that. So there was economic downturn as a consequence of that. And then throughout this entire crisis, it happens. And then after that, there are regulatory reforms that come afterwards. And we're going to chat about those regulatory reforms, specifically the Dodd-Frank Wall Street Reform and Consumer Protection Act. So what this act is it was a very complex and comprehensive piece of financial reform legislation, and it was enacted in response to the financial crisis. It was signed into law by Young Obizi, the homie, and it was named after its sponsors, so Christopher Dodd and Barney Frank. So yeah, let's look into some of the reforms that were proposed by the Dodd-Frank Wall Street Reform and Consumer Protection Act. So you guys can read this on your own because I'm not going to waste time reading something that's on the screen because I think it's pretty simple. But there was a Financial Stability Oversight Council that was meant to make sure that things like this don't happen again. There was the Volcker Rule, which named the former Federal Reserve Chairman, named after Paul Volcker. So the rule restricted banks from engaging in proprietary trading and limited their investment in things like hedge funds and private equity funds. So the goal is to prevent excessive risk taking by banks using federally insured deposits. Then there were Consumer Protection Acts as well, and then there was increased oversight, more regulation on mortgage-based or other financial derivatives. There was more oversight on credit rating agencies because remember, their ability to rate really bad mortgages as AAA rated mortgages meant that people had more confidence in them and no one could really see the problem behind it. So they were also a part of the problem. There were protections for people who were whistleblowers. There was just reforms around how mortgages are structured. So please read up on this act. Even if you just read this slide, I think you get a lot of information about it. All right, so I want to talk about the poor person, for example, because I think what happens often is people just think poor equates stupidity. So if you're not rich, you are either going to be you're going to be a victim of predatory advertising, or you're going to be a victim of people who are preying on you, and it's going to lead to you making financially irresponsible decisions. So I think that when we're evaluating which by the way, I want to place as an opinion, I think it is like very insulting to assume that people who have the least amount of money yet are still able to sustain themselves are unable to autonomize and financially plan because you think that being poor means that they're vulnerable and they lack brain cells. But we're going to look at how to analyze what is actually predatory lending and what isn't. So ability to consent is an important thing whenever you're establishing a predatory financial practice towards poor individuals. So we've gone through a criteria for what a valid choice is. So look into that. Look into whether or not they have the necessary information to make the choice. Is the choice being made under, force? So is it a choice that they are voluntarily making? So here, this is where the debate happens. I think some people argue that poverty is a extenuating factor that means that you reasonably cannot, like you are being forced to make certain decisions. Whereas the alternate to that argument is to suggest that there are many persuasive factors, and the ability to weigh up those persuasive factors is what underpins decision making itself. So just because there's a factor that is persuading you towards a direction doesn't limit your ability to weigh out that factor or to weigh up other factors. For example, I am sitting in the chair right now and I'm recording this. It's 7:30 a.m. and I haven't eaten. I'm hungry. I'm able to weigh up the fact that I have a biological need to eat over the fact that I have an intellectual need to make sure that you guys understand this content. So I'm making those weigh ups actively. So poor people equally have the capacity to weigh up the fact that they are in a cycle of poverty versus the fact that a decision they make could place them in an unsustainable situation or place them in a cycle of debt, or maybe spending on like a chain, for example, will mean that they'll go starving for the rest of the month. And their ability to make that decision is something that's not removed from their is not something that's removed by the fact that they're in poverty. Poverty is a factor to be weighed up. The converse to that is obviously suggesting that the extent to which poverty influences your ability to make decisions means that it is the equivalent of having a gun pointed to your head. That is to say, if a gun is pointed to your head, you have a choice to do whatever you want. You just have to weigh up whether or not you're going to live or die. So your choice isn't taken away from you. But that's not the case, because a choice between life and death is not a real choice. And the lived experiences of poverty mean that every financial decision sometimes is a choice between life or death. So please think about the ability of someone to consent when you're thinking about when you're wanting to discuss whether or not a particular financial decision is predatory, or whether or not it will be made irrationally. Also, there's a difference between a bad decision and an irrational decision, but we're going to talk about that later. Then the third conversation that I want to talk about is the exclusivity of irresponsibility, which is a really cool, not even cool, but I just think a valuable thing to note. The idea that being wealthy means that you have the right to make irresponsible financial decisions, but you are a non-autonomous being if you make financially like if you make the decisions that are not financially up to the norm, right? So what I mean by that is rich people are allowed to gamble on the stock market practically, and just literally gamble and splurge on things that have no productive value and have the possibility of just flattening them out entirely financially. They're able to gamble, lose their money, and use all of the credit institutions we just spoke about in this video in order to better themselves. But for some reason, poor people are less like deserving of the opportunity to also spend their money the way that they want. And for them, they're an issue when they what is it? It's an issue when they don't like have money, or when they spend their money on things that don't give them a valuable return. It creates an unnecessarily high standard for what it means to be a poor person, that you must be devoid of all forms of human error, and you must spend like a machine. You must think like a financial institution practically. You must think like someone who is always on a productive mode and never use your finances to act on your own utility as a person. So I think that's a valuable conversation to have, that even if you are plunged into debt, you have a right to make decisions that can plunge you into debt as much as the next person. Rich people have financial institutions to remove them from those situations. So we think, to a similar regard, poor people could also access avenues to plunge them out of those situations, and we need not make those decisions for them. The converse, of course, is to suggest that poor people or rich people can do it because they have a greater financial security net. Poor people don't. Then there is the value of credit, which is just the conversation of poor people need to be making risky decisions so that they can build their credit score, and that could even help them alleviate that poverty. So risky financial decisions are a necessary aspect of being able to accumulate wealth, like we've discussed throughout the entirety of this video. And blocking people out, or poor people, from accessing financially risky decisions means you block them out from their ability to accumulate wealth, and you make sure that they remain in the cycle of poverty that they are presently in. So there are a lot of things to understand the poor person, and I think we're not doing them enough in debating. All right, cool. Then I just want to give you some more pure based analysis or examples of why poor people are not financially stupid. So these are some studies that were done, and I would read through them, but it seems like I've kind of ran out of time. And I have my first, yeah, I think it's my first. I have my first call session with you guys now. So yeah, just read up on these. I think they're very interesting. And they would provide evidence for why poor people are able to make sound financial decisions. Okay. Again, sorry for the imagery that's being invoked by this, but I think that the song story of OJ is very valuable in showing how sound or even risky financial investments for the Black community are valuable in escaping the situations that we're placed in. So I really wanted to use it as the imagery throughout this video. And as the last time you will hear my voice in a teaching space, I just want to say I have had an incredibly stressful and fun time coaching with you guys this year, and I hope that this video was valuable, and I hope that the entire training experience this year was valuable. In the words of DJ Drama, with that, we're gone. Holiday season.